I'm here with Scott Kolbrenner, Managing Director and Head of Engineering and Construction at Houlihan Lokey. Thanks for joining me, Scott.
Good to see you, Richard.
A lot of people are talking about the a potential rise in interest rates and how that's going to affect M&A activity here through the second half of the year. What's your opinion?
I think a rise in interest rates will have more of an impact on private equity buyers who rely more on leverage financing to do their deals. But I think there's a long way to go to get back to a normalized level of interest rates. So we're at such a historically low level that there's a lot of running room to go that will still allow for significant M&A on the private equity side. On the strategic side, many strategics we've seen have built up a nice war chest, both of debt capacity as well as actual liquidity or cash on the balance sheet, as well as the ability to use their own stock for deals. So we don't think it'll have much of an impact overall on the M&A side of things from the strategics or really overall.
Do you think deal activity is going to continue at the same pace, or do you think it will increase or decrease?
Based on what we've seen in terms of our backlog right now, Houlihan Lokey, we're at about 38% higher backlog today than we were a year ago. So if that's any indicator, which I think it's a pretty great one, we think the deal activity is actually going to increase over the next 12 months compared with where it was a year ago.
Just switching the conversation slightly, when we look at a potential rise in interest rates, how could that in turn affect dividend recaps and debt refinancings? Is there a rush of activity anticipating a rise in interest rates?
We've had a number of clients who've considered dividend recaps, and they've looked at it, and there's a whole bunch of reasons in addition, including interest rates, why they may take a dividend recap. Could be timing, could be performance of the company. So at this point, we don't see many of the firms who are quite experienced at looking at different cycles. We don't see a rush to do a dividend recap. If the timing is right now, timing is likely to be right in 3 months or so from now. There's a whole host of characteristics that people will think about.
A lot of companies have already refinanced their debt, pushed out maturity dates for the next few years. Will we see much more debt refinancing through the second half of the year?
Oh yeah, I think many companies are in very good shape, taking advantage not just of the interest rates, which we've talked about, but taking advantage of the strong terms that lenders are willing to provide, because people are eager to put money to work. So I think that many people will have already done their refinancing, but continue to take advantage of what are still very strong debt markets.
To speak to your specialty in engineering and construction, let's take the conversation there. How do you expect a potential rise in interest rates? I assume that we're going to find a similar answer in terms of deal activity in those sectors.
Well, many of our firms, the engineering and construction sector, focus in energy. So oil and gas and power, for example. And a lot of that activity, whether M&A or financings, has not been driven by an interest rate environment, but has really been driven by the underlying operations for the business.
Thank you very much for your time today. I appreciate it.